U.S. dollar rebounds amid Fed rate cut speculations. Swiss franc weakens. The U.S. dollar's recent tumble has many on edge, but it's not a simple story of decline. The greenback staged a modest bounce back on Monday after a dramatic Friday that shook investor confidence. What triggered this roller coaster? It was a perfect storm of a disappointing U.S. jobs report, the sudden resignation of a Federal Reserve governor, and President Donald Trump's controversial dismissal of a key government statistics official. But here's where it gets controversial. These events not only rattled the currency, but also sparked intense speculation about the Federal Reserve slashing interest rates soon, creating a complex puzzle for investors. On Friday, data revealed that U.S. job growth for July fell far short of expectations. To make matters worse, the employment figures for the 2 previous months were significantly downgraded, showing 258,000 fewer jobs than initially reported. This suggested the labor market, once considered robust, might be weakening substantially. However, despite this alarming sign, some analysts like Carl Shimada, chief market strategist at Corpay in Toronto, argue that solid corporate earnings have so far helped to offset worries about a faltering job market, the impact of rising tariffs, concerns over the independence of U.S. data agencies, and the potential for a more dovish Federal Reserve under a new chair. The firing of BLS Commissioner Erica McIntyre by Trump was a dramatic move, with the president accusing her, and by extension, the agency, of manipulating job data to undermine his administration. This action has raised serious questions about the credibility and political independence of the U.S. labor statistics program. Meanwhile, the unexpected resignation of Federal Reserve Governor Adriana Kugler pivotally opened the door for Trump to reshuffle key Fed leadership earlier than many anticipated. Trump has been openly critical of the Fed's reluctance to cut interest rates faster. Friday's developments sent shockwaves through currency markets. The dollar plunged more than 2% against the Japanese yen and around 1.5% versus the euro. By Monday, however, the dollar had stabilized, trading steady at 147.32 yen. The euro and British pound both saw modest movements, with the euro sliding slightly to 1.1562 and the pound holding steady near 1.3281. Trump announced over the weekend plans to name new leaders for both the Fed and the BLS within a few days, keeping the markets on edge. Against a broad basket of currencies, the dollar nudged up 0.2% to 98.82, recovering some ground after its sharp 1.3% fall on Friday. It's worth noting the dollar had surged 3.4% in July, the biggest monthly gain since April 2022, as investors had grown more comfortable with Trump's trade policies and the resilience of U.S. economic data despite tariff pressures. On the bond market front, the yield on the 2-year Treasury note, the most sensitive to Fed policy, dropped to a 3-month low of 3.659% on Monday. This was driven by a surge in expectations that the Fed will reduce interest rates in September. The 10-year benchmark yield also hovered near its 1-month low at around 4.2257%. Using futures data, the markets now assign an 84% probability to a 25 basis point rate cut next month. Projections indicate nearly 60 basis points of easing by December, implying at least 2 cuts and a 40% chance of a third, a forecast reflecting growing concerns about the weakening labor market and economic slowdown. Currency movements against other major players show notable shifts as well. The dollar gained over 0.6% against the Swiss franc after the Trump administration imposed some of its highest tariffs on Switzerland in a broad attempt to reshape global trade relationships. This move led to a sharp decline in the franc's value, with the euro rising 0.4% against the Swiss currency, reaching 0.9351 francs. Analysts like Al Saraf from Danske Bank caution that if these tariffs hold, Switzerland's economy could face significant headwinds going forward. This unfolding scenario raises an important question. Will political interventions into independent institutions like the Fed and BLS undermine market confidence in the long term? And could the pressure on the Fed to cut rates inject fresh inflationary risks instead of stabilizing the economy? These are the debates generating sharp divisions among economists and investors alike. What's your take? Is this a necessary recalibration in response to shifting economic realities, or a dangerous politicization of critical financial institutions? Share your thoughts below. This conversation is just getting started. Why the dollar is plummeting, analyzing the latest jobs data. When it comes to the U.S. economy, perception can shift in an instant, and Friday's jobs report has sent shockwaves through global markets. The dollar, which had been clawing its way back after months of decline, took a nosedive as newly released data revealed just how fragile America's economic recovery truly is. But here's where it gets controversial. Was this downturn inevitable, or are there deeper issues at play that investors and policymakers have yet to fully grasp? Let's break it down. For much of the year, the U.S. dollar has been on shaky ground, losing nearly 9% against foreign currencies when measured by the DXY index, a benchmark used to track the greenback's performance against a basket of major currencies. This steady erosion reflects growing concerns among investors about President Donald Trump's trade policies, particularly his aggressive use of tariffs. Back in June, the dollar hit a low point, dropping more than 10%. However, recent weeks saw some signs of life, with the currency staging what looked like a modest rebound. That momentum came crashing down on Friday, after the Bureau of Labor Statistics, BLS, delivered grim news about job growth. Revising previous estimates downward significantly, the dollar plummeted off a metaphorical cliff. It fell sharply from 100.22 on the DXY index to 98.82, a substantial move for a currency as massive and influential as the dollar. According to analysts, this drop marks one of the largest single-day declines since May 23, underscoring just how seriously markets are taking these developments. But why does this matter so much? To understand, you need to look at what happens when confidence wavers. As George Vesey of Convera explained to clients, the dollar index suffered its biggest one-day drop as markets swiftly reassessed the outlook for rates and growth. Translation? Investors suddenly realized that the U.S. economy might not be as robust as they'd hoped. And this is the part most people miss. Weak jobs numbers don't just hurt hiring. They ripple across asset markets, affecting everything from stocks to bonds. Chris Turner, an analyst at ING, described the situation as the dollar's handbrake turn, highlighting how abruptly sentiment shifted. He pointed out that Friday's disappointing jobs report effectively dismantled any optimism surrounding the dollar's recent rally. In fact, traders now believe there's an 80% chance the Federal Reserve will cut interest rates by 25 basis points in September. That kind of uncertainty doesn't just impact monetary policy. It adds risk premiums to both the dollar and Treasury yields, making them less attractive to international buyers. Goldman Sachs weighed in too, dubbing the week USD Whiplash Week due to the wild fluctuations. Jan Hatzius, the bank's chief economist, offered a sobering prediction. U.S. GDP growth could slow to just 1% in the second half of the year. Meanwhile, Kamaksha Trivedi, another Goldman Sachs expert, challenged the prevailing narrative around Trump's trade deals. While media coverage often portrays these agreements as victories for the U.S., Trivedi argued that the real costs fall heavily on American businesses and consumers. Why? Because the broad scope of tariff increases makes it difficult for companies and shoppers to find affordable alternatives, ultimately harming the nation's terms of trade. So, what's next for the dollar? With so many variables in play, from weak employment figures to lingering doubts over U.S. economic strength, the road ahead remains uncertain. One thing is clear, though. The dollar's struggles on foreign exchanges today reflect broader anxieties about America's role in the global economy. Are we witnessing the beginning of a prolonged period of weakness, or will the greenback regain its footing? We'd love to hear your thoughts. Do you think the Fed should act sooner rather than later to stabilize the economy? Or do you believe the market is overreacting to short-term data? Share your opinions in the comments below. Let's start a conversation.